Hi, and welcome to the Charles Schwab case study by Team Charlie. Team Charlie is Brian Bowles, Alana Pierce, Rachel Moore, and Luke Bradley. Charles Schwab was founded in 1971, and in 1975, Charles Schwab became the first discount self-service financial services firm. It grew rapidly, and by 1991, it was the top of the brokerage industry. By 1996, its online trading platform, which was relatively new at the time, had 2.2 million clients. In 1999, with the increased use of and accessibility to the internet and the passage of the Gramm-Leach-Bliley Act, which allowed more companies to enter the financial services market, like insurance companies, competition really increased in the financial services market. Also in the early 2000s, that's when there was a stock market decline. And at that point, the customer base for financial services was changing. People wanted more control over their own investments and were choosing to make more specific decisions on how to manage their investments. And despite this market decline, in the early 2000s, wealth of individuals actually increased. And by 2003, 4% of households were millionaires. And then the structure of the financial services market changed around this time as well. And instead of it being commission based, it became service fee based. So they would earn a certain flat fee per transaction instead of a commission per transaction. So by the early 2000s, Charles Schwab was trying to find his place in this changing marketplace, internet competition, different financial models. And then between this full service financial firms and then these internet based discount brokers. It's also important to look at where Charles Schwab's products were in the product life cycle. As we mentioned earlier, Charles Schwab started in the 70s and experienced rapid growth. So we can see the beginning of this green curve here, the introduction, the growth, and I would say the maturity was probably around the 90s. And by the early 2000s, it was facing this decline stage. Sales were going down and profits were going down. By 2004, revenues at Charles Schwab flattened out, and the net income of the company had declined by 39% from the previous year. Chuck immediately came out of retirement. He had retired just previously, 2003. He had been on the board. Um, he had been slowly transitioning out of the president's role and the CEO role over the early 2000s. But as soon as the revenue started declining, he came out of retirement and immediately cut costs by 10%. He also slashed prices to provide more value to their product. Not only were sales going down, but customers were actually leaving Charles Schwab. In early 2004, 35% of clients were leaving because they wanted lower fees, and 45% of the assets withdrawn went to other discount brokers. Customers no longer felt that Charles Schwab was providing a good value. Around the same time, Charles Schwab did a brand study on the perception of momentum of the business and the perception of Charles Schwab in terms of innovation. Overwhelmingly, as you can see in the orange bars here, consumers recognized that the company was as just holding steady. They weren't on their way up or way down, and they weren't being innovative or less innovative. They were just kind of the middlemen. Okay, so we've recognized that there's a brand image problem and that people felt like they could get better values from other places. But there's some opportunities that Charles Schwab has, and we can look at the data that shows that. Charles Schwab created different lines of business to target different market segments. They continued their retail discount investor services, but they also supported advisor firms, represented in blue here as institutional, and created the U.S. Trust in yellow to serve the extremely wealthy. As you can see here, it's obvious that most of Charles Schwab's revenue comes from individuals in their retail investor services, the 61%. Okay, so the marketing department did some other additional studies, and they broke up consumers into different segments by their investment attitude and desired retail services. As you can see here, the largest population segments are those who are confident and self assured, those who are unsure but concerned, and advice seekers who also want high touch services. In 2005, Charles Schwab started the Talk to Chuck campaign. This campaign was rooted in leveraging Chuck, Charles Schwab, the founder, as someone who's approachable and knowledgeable in this very complex and formal product category as financial services. It was a way to easily relate the core values of the company in a very visual way, a very personal way, accessible way, directly to the consumer. The goal of the campaign was to recruit new customers and new assets. And the campaign touched on most marketing touchpoints, including print ads, billboards, coffee sleeves, online ads, and even TV storyboards. It emphasized value as well as the accessibility um, to Chuck as someone that represented the core values. It really emphasized value, low cost, high performance. The company invested the entire brand budget of $30 million in the Talk to Chuck campaign. Before taking it nationwide, they ran a test on 26 markets for 6 months. And this turned out to be very successful. They found an increase in brand recallability, differentiation, perception of a growing company, and then most importantly, they actually got new customers and new assets. Of course, one needs to look critically at the test Talk to Chuck campaign test results to make sure that the test had enough integrity for the company to actually rely on the results. And there are a couple aspects of the test that may not relate to how the campaign would play out nationally. The first of these is that they didn't do the test in any cities where Charles Schwab or any of its campaign, competitors were headquartered. And Charles Schwab is really going to have to compete in those cities, so it's kind of hard to tell if they would be as successful as they were in the test. Second was that they really focused on cities where they already had a strong field sales presence. So would they do as well in cities where they didn't already have this strong sales presence? And the third thing is that Chuck went to all the cities himself to bring all the salespeople on board, to orient them, to really get them on board with this campaign. And is this something that he can do with all the cities in all other major markets? On the other hand, the test did have good control tests where they had cities that they did not run the campaign so they could um, see the difference in success between those different cities. And then they also had control for seasonality over the 6 months. So, all in all, I think that the test seems good enough to justify the increase in campaign spending, but not enough to run financial projections on this test, based on this test. Marketing director Becky Sager wanted to raise the marketing budget to $200 million for 2006, and this is up from basically 195 million in 2005. And she wanted to increase the Talk to Chuck campaign budget from 30 million to 55 million. So the next step is to see if this is financially feasible. This graph shows advertising budget as a percentage of revenue. And as you can see here, a request for 200 million would not be out of line with previous advertising spending. In 2001, it was 6%, but the last couple years it was around 4%, which is basically what she would be asking for 2006. However, Chuck is intent on keeping costs low to pass value on to the consumer. To break even for the campaign budget specifically, they would need over $13 billion in net new assets to manage. To look at historical asset growth here in this chart, even in years where asset growth was declining, Charles Schwab had significant new assets. To add another $13 billion in 2006 to 2005's new asset numbers would only be a 17% increase. In the Talk to Chuck test market results, the net new assets increased considerably. In new households, they increased by 37%, which is nothing to scoff at, but it pales in comparison to the increase in existing households, which increased by 173%, the second bar here. So, and for a total increase of net new assets of 210%. It's interesting to note that it's not the new households that are bringing in the net new assets, but it's really the existing households they're bringing in the net new assets. So it seems like asking Chuck for additional marketing funds to fund the Talk to Chuck campaign seems like a no-brainer when you have the possibility of increasing the assets managed by almost 200%. And it seems very conservative to project that the campaign could earn at least 17% in additional assets. So even without the Talk to Chuck national campaign, net assets increased by 50% from around 50 billion to 75 billion, as we saw in the last chart. So an increase for another 17% again seems very conservative. Now we need to look at how Charles Schwab should proceed. What is its overall strategies? And most of this is going to relate directly to its brand. Charles Schwab's brand case is very reminiscent of Manny Jackson's article, Bringing a Dying Brand Back to Life, in regards to the Harlem Globetrotters. The Harlem Globetrotters almost went extinct because its brand was not carefully managed, and we could see the same thing happening with Charles Schwab as it's going down in the decline of the product life cycle. We are going to look at Manny's recommendations. He said that there are 3 principles to reinvigorating a brand: reinvent the product, show you care about the customer, and have an accountable organization. We have a series of strategic recommendations based on Manny's 3 principles. Our first recommendation is to continue to leverage Chuck as the brand. Continue to reinvest in that brand and manage the brand. Our second recommendation is to continue to keep costs low for the brand so that there's still this perception of value. High knowledge, low cost. And also for efficiency in the organization because the margins are so low. Our third recommendation is to renew existing relationships. As we saw in the Talk to Chuck campaign results, it was really the existing households that was bringing in the highest, that was leveraging the highest new amount of new assets. So instead of focusing on new households, focus on existing households and renewing those relationships. Our fourth recommendation is to focus on the retail end of things. As we saw, 61% of Charles Schwab's business line is focused on the individual investor, and that's where they should continue to focus. To start with this renewal and rejuvenation of their product and brand, Charles Schwab needs to redefine their target market, and they did so in the case. They decided to target the mass affluent, people with assets of $50,000 to $2 million, who were confident and financially concerned. These were people that were seeking reasonably priced advice for long-term relationships. Okay, we're going to talk about specific tactics as they relate to the strategies that we mentioned earlier. So first off, Charles Schwab needs to continue the Talk to Chuck campaign and have all promotions centered around this theme. And they need this theme to reintroduce their product and brand to existing and new customers. They really need to hit all marketing channels at once and really hard to bring awareness of the product back to the consumer. Manny Jackson says you need to have 3 events in quick succession in order for the consumer to remember you. And that's exactly what Charles Schwab needs to do. And of course, within the advertising, they need to really differentiate themselves. They need to emphasize how accessible yet affordable they are compared to all these other companies. And they should do it through benefits based advertising. The marketing channels should focus on business people oriented media like financial magazines, luxury media like luxury travel websites and publications, and then certain trade publications where employees make within the target income range, such as doctors' journals and lawyers' publications. One of the key aspects to Charles Schwab and the success of the Talk to Chuck campaign is accessibility for people that want help because they are unsure about their options and how to proceed. One of the key marketing tactics that Charles Schwab needs to keep in place, therefore, is the on the ground presence by having all the retail locations with in person salespeople. Chuck was absolutely spot on to go in person to these locations and explain the campaign and renewal of the product so salespeople can get on the same page and accurately translate that enthusiasm and confidence to the consumer. As mentioned earlier, Charles Schwab was targeting new clients for additional assets, but in the short term, it seems like the profitability will come from existing households, so Charles Schwab needs to reinvest in these clients. Using the personal sales team to follow up with existing customers to emphasize key points of the Talk to Chuck campaign and gather any feedback about customer satisfaction can go a long way to reinforcing and reestablishing these relationships. And those tactics take care of basically 4 of the 6 P's: the personnel, place, promotion, and presentation. The price and product P's for tactics for Charles Schwab. Price and product are almost synonymous because Charles Schwab's product is essentially the good value in financial services, is that low cost service. One of the things that Chuck did when he came back was to cut expenses so Charles Schwab could be sure to maintain the key component of the product, the low price. Chuck is not looking at the competition nor looking at the cost in order to set the price for the services. He's looking to give the customer what they want at a price at or below how they value it. And through this method, he has been able to build a very successful company both in terms of sales and especially profits. One of the ways that Charles Schwab was able to be so successful was its early investment in technology, specifically computer-based trading. Charles Schwab needs to continue to focus on innovation and at the very least stay at the front of the curve for new investing technologies and interfaces. In conclusion, Charles Schwab has a good brand and a good product. It's mostly a matter of redefining who they are and differentiating themselves by building and reinvigorating their strengths within the increasingly competitive and complex market.